Hello everyone, thanks for checking out my video. This is another video on options trading for beginners. If you have not watched my previous videos, do check them out first. Anyway, in this video, I will cover my personal top beginner-friendly tips and tricks of options wheel strategy that I use to increase my win rate. In fact, if you were to follow what I practice, you almost cannot lose money. Okay, in case you think this is some sort of exaggeration, let's visit this again in the middle of the video. In addition, I will also share with you the stocks that I would consider for the options wheel strategy, so do stay tuned to find out more. Alright, let's set some context first. These tips and tricks are mainly for the options wheel strategy, so you will need some basic understanding of this strategy before we can carry on. And if you don't know what is an options wheel strategy, please check out my earlier video or click on the link at the top. Anyway, in a nutshell, the options wheel strategy involves selling cash secured puts and covered calls. Okay, I need to emphasize this again. It's cash secured puts and covered calls. They do not apply to naked calls and puts. And in case you're not aware, selling or writing options is already a move with a higher probability of winning. You can do a quick Google on this, as there are many researches done on it. The reason is simple, because at the end of the day, when selling options, you don't have to be 100% right. You only have to be approximately right. That's the beauty of it. And so right now, I am going to share with you how I further improve this win rate with 4 tips and tricks, which are really easy to understand. The first most important tip for options wheel strategy is stock selection. Sounds simple? Well, you will be surprised so many retail investors or traders have traded all the pandemic-driven stocks such as Sea Limited, Zoom, etc. and Cathie Wood stocks such as Teladoc Health, Roku, Block, Snap, Lemonade, and the list goes on. Worse still, meme stocks such as AMC and GameStop, or those IPO hypes such as Grab and Lucid. Among these stocks that I have just mentioned, pull out any random names, see Lucid, Teladoc Health, Lemonade, etc. They all have dropped 80 to 90% since they hit their all-time high during the COVID period. AMC has plunged more than 95%. If you are one of them who have sold put options on these stocks, it's either you have rolled them multiple times or are still rolling them to save your trades. If not, you probably had accepted assignment with a high cost price and ended up being a backholder. Okay, let's just use an example, Sea Limited. If you had sold a put contract when it was at $200 to $300 range and had accepted assignment of the shares back then your cost price for each share that you are holding on will be around that range. I mean, even if you had managed to roll the put option initially and accepted assignment at a later date or at a lower strike price, say $100 range, you are still back holding this trade at very high cost price, given that C is trading below $50 now. More importantly, you probably cannot continue your wheel strategy by selling covered calls on your existing shares at its $100 cost price, because the premiums are so insignificant. The screenshot here shows that you can only earn about $30 premium out of the $10,000 worth of shares you are holding on to, with super long expiration date. And mind you, this is if your cost price is $100 per share. I am not even talking about $200 or $300 range. I mean, imagine if the cost price is much higher at $200 or even $300 and you want to sell a covered call with that high strike price. Well, sorry, I don't think your broker even offers such a high strike price to you. As you can see from this screenshot, I have selected an expiration date that is almost 1 year out, and the highest strike price that was offered on the broker is only $130. And just a word of caution here, if you go with a strike price that is lower than your cost price, and if C closes above, say, the strike price of $130 in 1 year's time, you may be forced to sell them at $130 per share, while your cost price can be $200 or $300. This means you are realizing or locking in your losses. So what I am trying to say here is that what may seem simple, in this case stock selection, but often it is the toughest thing to do. Okay, for me, I only choose stocks with strong fundamentals and a history of stable performance for my options wheel strategy. For long-term viewers of this channel, you will know that my option trades revolve around Apple, Google, Tesla, and occasionally Microsoft and Bank of America. A look at the charts show that Apple, Google, and Microsoft all had recovered from 2022's bear market low and went even higher than the record high that was set back in the pandemic days. As for Bank of America and Tesla, okay, got to be honest and not gonna hide anything here, they have yet to recover to their pandemic high. But in my opinion, both are great companies with very strong fundamentals. I mean, we are talking about Bank of America, which is the second largest bank in the United States by assets, as well as by total deposits. As for Tesla, yes, it is a controversial company, but it is still the top 10 US companies in the fast-growing EV and AI industries. Again, I know this is debatable because it does occasionally fall out of the top 10. But well, I am not here to convince you to believe in Tesla's story. Anyway, other than being fundamentally sound, another reason why I select Tesla to do my options wheel strategy is because of its volatility. But we will save this volatility topic for another options video. All in all, my point is select real solid companies for your wheel strategy and not those hype up startups or companies with unstable financial or earnings record, or companies without economic moat, or worse still, companies that are still unprofitable and burning cash day by day. Okay, a quick disclaimer, what I am going to share next is not any form of financial advice or stock recommendations, okay? Please do your own homework, alright? Alright, so some of the stocks that I consider doing options wheel strategy to increase my win rate are those that I mentioned earlier, as well as these companies, namely Nvidia, Meta, Amazon, AMD, Johnson & Johnson, Coca-Cola, Starbucks, JP Morgan Chase, or indexes such as the SPY or Triple Qs. From this list, I will break them into two categories. One is called the decent IV and decent premiums category. Basically consists of the Magnificent 7 and AMD, while the other category is called slow and steady plus beginner friendly. Just to add on, some of the beginner friendly stocks are budget friendly as well. So basically, for beginners who are just starting out on options wheel strategy, this category of stocks do not require them to stand by lots of cash if their sell put contract goes against them and they had to accept assignment. Also, just to share with you, I personally started out with Bank of America and I only needed less than $4,000 on the sideline to prepare for assignment versus say Nvidia, Microsoft or Meta where you need $40,000 to even $70,000 on standby. To add on, some of these slow and steady moving companies pay decent dividends too. Therefore, if you end up getting assigned with their shares, you can still collect dividends as another form of income, which I have covered in my last video on options wheel strategy. And because their share prices move quite steadily, when you get assigned with their shares, you will likely be able to sell covered calls with a strike price that is the same as your cost price or even higher. Okay, at the end of the day, whichever stock you select, it really depends on your very own research, your risk tolerance, your preference of a more volatile or less volatile stock, etc. So please conduct a thorough research before starting your options wheel trading journey. Perhaps for a start, go with stocks with lower volatility to reduce the likelihood of a significant price swing. Basically, there is a lesser chance for the stock price to move against you, which in turn increases your win rate with the contract expiring worthless. Also, when you select a good company, even if you get assigned, you know the company will not plunge too much. Even if it does plunge, it will likely recover soon, and from there, you will be able to sell covered calls with decent premiums. Okay, that's quite a long one for the first tip, but I really couldn't emphasize any further on the importance of stock selection. Anyway, if you had realized, I have mentioned rolling an option multiple times earlier on, so that brings me to the second tip, which is to roll an option. Okay, basically rolling an option is a strategy used when an investor closes an existing position, and opens a new one. The two common reasons for rolling an option is to: number 1, adjust the strike price; number 2, adjust the expiration date, or both. Okay, that's 3 reasons. And the common objective for doing this is to save a losing trade. But there are traders who do it to capture more potential profits. But because this video is for beginners and it's about increasing your win rate, let's focus on the common objective, which is to save a losing trade, or in other words, converting a losing trade to a winning trade. Alright, there are 3 main types of option rolls: rolling up, rolling down, and rolling out. First, to roll the option up means investors choose to close their current option position and open a new one with a higher strike price. Second, to roll the option down means investors choose to close their existing option position and open a new one with a lower strike price. Finally, for rolling out, it means to close an existing option position that is near expiration date and concurrently open a new position with a later expiration date. By doing so, it gives the investors more time for the stock to move in their favor and to avoid assignment. Just to add on, a lot of brokers allow you to roll your options in one click. In other words, to close the existing position and open a new one in just one click. Anyway, let me show you a real example of rolling an option and how to convert a losing trade into a winning trade, which in turn increases your win rate. I will go a little slower so that you will be able to catch what I am saying and digest the information. So, back in 4th April 2022, Bank of America was trading at around $40, and I sold a cash secured put on the stock with a strike price of $38, expiring 6 May 2022. As a result of this trade, I received a premium of $70. Do feel free to pause this video for a while as you interpret and digest the screenshot at the bottom. And don't forget to like this video if you found my content useful so far. Alright, by the way, fun fact, this is my first ever Virgin options trade, and it didn't go too smoothly. As you can see, at one point, the trade was down close to 200%. So let me show you how to save this losing trade and convert it into a winning trade. Here's what happened. On the expiration date 6th of May 2022, the share price was floating below my strike price of $38 during intraday. And at that point, the trade has managed to recover a little bit and was down around 29%. Again, as mentioned earlier, you will need basic options wheel strategy knowledge to understand what I am going to share next. So at that point, I have several options or choices. First, I could either accept assignment, which means to take on 100 Bank of America shares at $38 per share, or I can realize my loss by buying back the contract at a more expensive price. But by doing so, I would have lost 29%, as you can see on this screen. But there was also a third choice, which is to roll the option. And because I didn't want to accept any assignment on my very first option trade, so I chose to roll the contract. So what I did to save this trade was to close my initial cash secured put at a loss by paying $85 premium. And then I sold a new cash secured put with a new strike price of $36, with a new expiration date of 27 May 2022. For selling this new put contract, I received $92 premium. Okay, let's break down the details a little bit more. As you can see, I lowered my strike price from $38 to $36 and also extended my expiration date from 6 May to 27 May 2022. Remember what we have learned earlier? This is called rolling down and out. By doing so, it gives the stock more time to recover or moves in my favor. And to add on, the new strike price is lower, which means the bar is set lower, as the stock does not have to close above $38 anymore. It just has to close above $36 will do. Just to also highlight, when I was rolling this contract, I make sure that I did it with a credit. So here's the calculation. I received $70 premium at the start for selling the first cash secured put. I then paid $85 to buy back the same contract, and this was followed by selling a new cash secured put and received $92 premium. The net amount for rolling this option is $77. By the way, if you notice, for the second and third trades, in other words, the rolling of the option was not done in a single trade or click, as the broker that I was using did not have this one-click function in the past. As a result, I had to manually close and open the trades. But right now, the broker allows me to roll my option in just one single click. Anyway, this $77 will be my profit if the second or the new cash secure put expires worthless, which it did. On the new expiration date, which was 27 May 2022, Bank of America closed at around $37, which was above my $36 strike price. So all in all, I profited $77 from this whole trade, as shown in the earlier calculation. Alright, I have spent quite a bit of effort and time to gather those screenshots and do up this video. So if you found this video useful, appreciate if you could simply tap on the like and subscribe buttons and comment something below. All these actions will help with the YouTube algorithm. At least that's what people are saying. And if it's within your financial means, you may also consider buying me a super thanks or a cup of coffee via my Ko-Fi link. Anyway, that's how you increase your win rate by converting a losing trade into a winning trade by rolling the contract. And when rolling options, aim to receive a net credit by selling the new contract at a higher premium than the cost of buying back the current contract. On a side note, how nice, right? My first trade as a beginner had already given me the opportunity to have a taste of a trade that went against me. In fact, at this point, I thought just to bring back what I have shared at the start of the video, you almost can't lose money if you have cash on standby, select a fundamentally strong company to will, and basically keep selling cash secured puts and covered calls, rinse and repeat. But of course there is a caveat, and that is if you apply the wheel strategy on a bad stock and the share price may never recover after a steep decline, which means you may have to backhold it for years, or perhaps even forced to sell it at a loss. Alright, let's move on to the third tip to increase your win rate, and that is to use technical analysis when trading options wheel strategy, specifically to select strike price for your sell put or sell call options. Okay, I know technical analysis may sound very complicated, but don't get intimidated by it. Just to clarify, for a start, you actually only need to pick up some of the basic ones. You really don't need to do complicated technical analysis. You also don't have to use complicated indicators and patterns like Elliott wave, Ichimoku cloud, Fibonacci levels, various candlestick and wedge patterns, bullish and bearish divergences, and MACD, etc. So right now I am going to share just two simple and basic ones that can increase your win rate for trading the options wheel strategy. First of all, it's the support and resistance levels. They are levels or areas where the stock tends to bounce or fall. How you can identify support and resistance levels as a beginner is quite simple. Alright, let's pull out Apple's chart. So if the stock falls to a particular level or area and tends to bounce up, that's called a support level or support zone. For a start, try to give it a range instead of looking at a single level or a very precise level, because the rebound may not happen exactly at that particular level. You should only use single level when you are equipped with more TA knowledge. On the other hand, if the stock rises to a particular level or range and tends to fall, that's called a resistance level or area, because the share price keeps getting rejected as buyers kept stepping in. Okay, now let's take this another level higher, just a bit more for you to learn. So when the stock falls below the support area when it usually bounces up, then this support area will become a resistance zone, because moving forward, the stock will likely face resistance at this very level or area when it tries to go above it. We usually call this support turn resistance. Likewise, if the stock managed to climb above the resistance area, that resistance area will turn into a support zone, because moving forward, sellers may find it tough to bring the stock back below the support area or levels again. Alright, so far so good, able to digest what I have just shared? Okay, now let's cover how do we apply this to options wheel strategy. First and foremost, if there is a particular area or level that the stock tends to bounce up, it means that this area is a strong support zone, as sellers find it difficult to break below it. Therefore, if you want to sell a cash secured put, you can consider selecting a strike price that is slightly below this support area, because there is a higher probability for the stock to bounce up than to fall below this area whenever the share price goes near it, which means the probability of your strike price not getting breached is higher. In other words, increase your win rate. On the other hand, if a particular area has always seen the stock getting rejected, then that is a strong resistance zone. This is where you can consider selling covered call at a strike price slightly higher than the resistance area or levels, because the odds or probability of the stock getting rejected again at this particular area is higher than it climbing above. Next, in terms of indicators, one of the easiest indicators to understand or look at is the Relative Strength Index, or RSI. It is a momentum indicator that tells you whether a stock is at overbought or oversold condition. So this is as simple as it can get. When the RSI moves above 70 or 80 level, it signifies that the stock is overbought, and there could be a possible pullback, as you can see from this Apple chart. Then, on the other hand, if the RSI moves below 30 or 20 level, it means that the stock is oversold, and there could be a possible rebound. In short, the lower the RSI goes, the more oversold the stock gets, and the higher probability that a bounce will happen. And the opposite is true. The higher the RSI goes, the more overbought the stock gets, and the higher probability that a pullback or decline will happen. So when the RSI is very oversold, you would want to sell put option in anticipation of a possible rebound, and make use of what I have shared earlier. Try to pick a support level or support area as your strike price, so that the chance of it bouncing up is even higher. On the flip side, when the RSI is very overbought, you would want to sell a covered call option in anticipation of a retracement or decline in the share price. And if possible, select a resistance level or resistance area as your strike price, so that the chance of the share price getting rejected at that level or area is higher. All in all, I just wanted to say you will be surprised by the result of incorporating simple technical analysis into your options wheel strategy. And of course, after you have mastered this tool, you can always pick up a few more others to beef up your trading or technical analysis skills, and in return, be able to make more informed decisions on your trades, and hopefully increase your win rate even further. Alright, here's the last tip of the video to help you increase your win rate for options wheel strategy. That is, when selling options, try to pick 30 to 45 days to expiration, or DTE in short. The reason is simple, because this time period offers you optimum time decay and decent premiums. In case you're not aware, time decay is referring to theta, which is one of the options Greeks. Okay, without going too technical and to explain in simple terms, time decay or theta is how much value an option loses day by day. So let's say you sold an option with a premium of $5. If everything else, including the share price, is constant or equal, this $5 worth of contract will lose value every single day. And on expiration date, the extrinsic value or time value will be 0. And if there is no intrinsic value in the contract will now worth $0. And that is what you as an option seller wants. You sell it for $5 premium, and you would want to either buy it back at a cheaper price, say $1, to make a profit of $4, or the best case scenario is that you don't need to buy it back as the contract value falls to 0, or what we call expire worthless. That's when you get to earn the full profit or premium of $5. According to a research carried out by Tasty Trade, there is evidence that suggests 45 days is somewhat an optimal number for DTE when it comes to selling off options. And now check out this graph. You will see that time decay increases as we go closer to the expiration date. The curve basically gets steeper and steeper as the contract approaches its expiration date. Until the last 30 days of the contract, time decay is the most rapid during this period. So when you add both up, it gives you the range of 30 to 45 days DTE. And this is a long enough window for the stock to move in your favor if the share price has temporarily moved against you. Okay, at the end of the day, it is important to know that options are decaying assets and lose time value daily. Yes, every single day. So keep that in mind. Therefore, if you are selling options, theta or time decay is a tailwind, and time is your friend. Time decay basically gives you some leeway such that you don't have to be 100% right, you only have to be approximately right, which I have shared earlier in the video. This is therefore why I prefer selling options over buying options, because I want time to be on my side. To use another analogy, if you are buying options, you are like holding on to ice cubes. They melt every single second, and in the case of options, the contracts that you bought decay every single day. Alright, wow, if you have stayed till here, good job. Thanks for staying with me. Do help to like the video if you haven't. Anyway, just wanted to say, although these 4 tips and tricks are quite common for trading options wheel, I do think they are very practical and useful, especially for newer options wheel traders. Okay, I do have some other hacks or tips that not many YouTubers talk about. Would you want to know? If so, comment down below so I know there are people who are keen to find out. Because it really takes a lot of effort to churn out such videos, and I am doing all this for free. Meanwhile, thanks for watching till this very end. The video is longer than I expected, but I thought I wanted to be a bit more thorough in sharing what I have learned so that viewers can benefit from this video. I hope you can give this video a like if you found the content useful. Thank you very much.